7 retirement planning assumptions to avoid. This is from Charles Schwab. So when Schwab speaks, people listen. Remember that old E.F. Hutton commercial? You youngins won't remember that, but back in the 80s, when we watched football, there'd always be an E.F. Hutton commercial on. When E.F. Hutton talks, people listen. And they'd be sitting out there at the restaurant, banging away in their silverware and whatnot, and someone says, well, my God, E.F. Hutton said, and all of a sudden be quiet. That's back in the day. We thought people had insider knowledge. Anyway, so let's take a look at what Schwab says here. My man Luis sent this to me, so we shall see what Schwab says. 7 faulty planning assumptions to avoid. Dateline November 22nd, 2019. Excuse me, big man. And this is articles written by, doesn't say. That's the thing. I hate when they don't put whoever. Do they put the authors on these articles? Nah, I wish they put the authors. I don't. I know why they don't. They don't want to give away the store. They don't want people recognizing an individual over the company name. I know that's why they don't, but I wish they would give it a little bit more personality, if you will. All right. So even the most, whoa, you okay there, big man? Yikes. You okay? Even the most disciplined financial planners can face unexpected hurdles. Your career takes a turn for the worse, or your child's education is costlier than you anticipated. And just like that, your savings goals can be in jeopardy. David Jameson, professional CFP with Schwab Intelligence Services, say people often operate under the presumption of control. Ultimately, failing to expect the unexpected can leave you far short of your desires. Here then is the reality behind 7 assumptions savers often make, and solution that you can keep from being caught short. Assumption number 1, my expenses will be lower in retirement. Okay, I just got to chuckle at it. Really? Schwab is now saying it's an assumption most people make now? I don't remember everyone making that assumption anywhere until just recently, and I'm not quite sure it's fully in the vernacular at all. I mean, that's the whole premise of the 4% rule. That's weird. Is that assumption most people make? And David Jameson says, many retirees find they spend just as much as in retirement as they did while they're still working. Plus, most want to travel and pursue other passions, and those things cost money. You also need to account for unexpected expenses and other costs such as healthcare, not all of which will be covered by Medicare. What's more, average life expectancy in the U.S. has increased roughly 8 years between 1970 and 2017, so your money may simply need to last longer than that of previous generations. All right, when estimating your retirement savings goal, assume your current expenses will remain the same minus the amount you're saving annually towards retirement. No, don't assume that. Why would you assume that? Assume Schwab doesn't have any incentive here to make you save, to help you save money, do they? Assume that your current expenses will remain the same minus the amount you're saving annually towards retirement. With FICA, is that something you're saving towards? I don't know. Would that be part of their cost that you're saving towards retirement? I just don't know. But anyway, from there you can calculate your target portfolio size as well as how much you'll need to save each year in order to reach your goal. Finally, factor in inflation, life expectancy. You can run the numbers, use an online calculator. Okay. If the outcomes give you pause, which they certainly will, consider revisiting your savings rates or strategize now on potential cutbacks. Medicare will cover my health care cost. Medicare doesn't cover many of the health expenses retirees will encounter, including most dental, vision, and hearing care. Yep. Perhaps more important, you have to pay out of pocket for long-term care unless you obtain supplemental insurance in advance. Let's see. Pretty common sense here. Consider contributing to an HSA. Excuse me, I got Pablo sitting here, made me yawn. He just yawned, now I'm yawning. If your employer offers one, okay, you may want to investigate long-term care insurance options as well, since the number of Americans needing long-term is exposed and support is expected to triple by 2050. Assumption 3, I'll be able to work as long as I want. Nearly 8 million older Americans are in search of work or stuck in low-quality jobs. David Jameson says many people take this as a given they'll be able to work as long as necessarily or desirable, but your health or circumstances may not allow for that level. Okay. I don't have anyone who's ever, assume that you'll be able to work as long as you want or need to. I should play it safe with my investments in retirement. reality check, although a conservative retiree's portfolio might be 20% equity and 80% cash and stocks, a greater allocation of stocks can help offset the risk of outliving your savings, says Rob Williams, who's a part of the Schwab Center for Financial Research. Indeed, analysis by the Schwab Center for Financial Research found that a retiree with 60% allocation of stocks was able to take larger withdrawals than a retiree with 20% allocation of stocks while maintaining the same degree of confidence that her money will last 20 years. All right, well, that makes sense. I mean, if you want more upside, you got to take more risk. First home, assumption 5, I can deduct the interest on my mortgage. Well, not really, simply because home equities you can't, as they talk about here, and standard deduction. Let's make sure they talk about the standard deduction. Be realistic about your mortgage interest deduction when evaluating true cost of your home. They don't talk about this higher standard deduction. Be realistic about your mortgage interest deduction when evaluating the true cost of your home, especially if you're counting on it when calculating the amount of taxes withheld from your paycheck. Because recent change the tax code, you can deduct the interest on. That's weird that they don't. That's okay. I can deduct the interest on my mortgage, but they don't talk about the increased standard deduction. That's a bad argument. Real estate is always a safe investment. No one ever says anything is always safe or always bad. That's nuts. No one ever said that. Because home prices can fluctuate, and just look, I'm telling you, look at my wife's old neighborhood. No one would ever sit there and say real estate is always a safe investment. So this is what we call this is straw men. We're putting up straw men arguments to knock them down very easily. No one says real estate is always a safe investment. Education debt is always worth it. No one ever says education debt is always worth it. I mean, the minute you hear never or always, I'm not so sure about that. Let's see. Higher education isn't all about return on investment, but you should nonetheless discuss it with your child what his or her choice of major could be. That actually wasn't that great article, that's why Louise sent it to me. He said, hey, there's your folks in your industry. More fuel to scare you. So anyway, that's Schwab for you. I don't have a problem with Schwab. This is a pretty, I don't know. These assumptions are, it seems a little bit far-fetched to me that many people have these assumptions. So I figured I'd read it to you. All right, we'll see you.